Does this sound like you? You bought into that IPO they told you was a good investment, and now you're down 20, 30, maybe even 40%. You try to buy the stocks they talk about in groups or on social media.
You've even taken a chance on the ones your advisor sends you via email.
But after 2 years, that IPO, that stock is still down.
There's a clear difference between investing and making a good investment decision. So if you're stuck, what you need to do is learn how to invest the right way.
In our Learn Level 2 program, we teach you how to build $1 million investment portfolio. To make money investing, you need to know which stocks are right for your investment strategy, know when is the right time to buy and sell, and know how to build the right portfolio for your investment style. This program will help you invest meaningfully while making money. When you sign up, you'll get monthly guidance on how to invest and make money while doing it. You'll have a community of investors on the same journey as you to support you, and you'll have resources to help you stay on track. Join our 2026 cohort so you can get back on track with your financial goals.
So something troubling that I've noticed, as I work with clients in coaching, right? The strategy that some persons have, where we'll be discussing their investment strategy, looking at their portfolio, and one of the things I'll notice is that you'll see maybe the last 4, the last 5, the last 10 IPOs, and I'll say, well, why is that? Why did you go with so and so company? Why did you do this? Why did you do that? And interestingly enough, the most recent client I met with says the guy who told me about it made it sound like it was a good company. And it made me start to think about, the strategy that some investors seem to have, where the strategy itself is buying into the IPO, right? It's this idea, or coming from this place where, if you remember 6 years ago, 7 years ago or more, IPOs were almost like a sure thing. But they're not really a sure thing anymore. They haven't been for a while, right? The last IPO that kind of went right out the gate and did really well, 50, 100%. I can't remember right now. It's been so long, right? But this idea that some investors are holding on to is still this idea that, I'm just going to build my portfolio through IPOs. So I'm going to talk about that today, and I'm actually going to lead to this strategy, talking about how you should be building your portfolio, right? So I'm going to get into a lot of kind of meat in this video. Hopefully this will help those who are brand new investors, and we just kind of see where we go from there. All right, and then of course at the end of it, I'll take your questions, comments, that kind of thing, like we normally do. So there's this kind of thing called, well, I call it like the IPO trap or the IPO buzz, right? So it's this idea that I'll say to persons that the thing about an IPO that you should understand, and by the way, before I get into this, I'm not making a knock on any specific IPO to itself, right? The things that I'm going to be focusing on in this video is more about how you as an investor is approaching the market, is approaching your investment strategy, right? I just have to say that, right? So there's this idea that person should understand that IPOs are usually heavily marketed. There's a certain amount of media attention around it. There'll be, interviews, coverage, newspaper articles, investor briefings, all of that good stuff, right? And so there's usually this kind of, a lot of kind of information flooding you about that IPO, right? This kind of media attention creates a certain buzz and excitement around the IPO, right? So you have this case where you're seeing it everywhere, you're seeing it advertised, maybe newspaper, TVJ, CVM, all the stuff, right? Social media, all the stuff. So it creates a certain buzz or excitement about it, especially if there are things about the company that are kind of easy to like. So it leads some investors to this very popular term, and tell me if you've heard the term before, called fear of missing out. So there are some persons who, will do a poll in our community usually, or on our YouTube channel, and we say, will you invest in such and such IPO? Some persons say yes, some persons say no, some persons say maybe. I feel like some persons may say no originally and give in to this fear of missing out and give in to this idea that they have to buy it because maybe they see other people talking about it. Maybe they'll feel like maybe this is the one that will do well, right? And so there's this fear of missing out that causes them to just kind of just go for it, even though they're like, well, I don't really know anything about this company. I don't understand this company. This company doesn't really fit into my portfolio, right? So this FOMO is paired with this idea that they are concerned that they may be wrong about this one, right? Maybe they were wrong in the past, or they were right in the past, but this particular one, the most recent one, whichever one that is, they may be like, this could be the one that's gonna do well, right? So here's a general issue with that. So when you go about building your portfolio, I look at an IPO as an interruption, right? Because the truth is, you don't typically know about the IPO until the day that the prospectus is released. So it is an interruption. You're building your portfolio, you're going about your business, and then here comes this investment opportunity that you may or may not have been ready for, that you may or may not, have the proper time to go through, because some are on short timelines, some are on long timelines. Either way, it's this idea of, you'd have started the year, started the month, or whenever, not having that IPO in mind. So because it's an interruption, sometimes it just kind of throws you off. So you're like, you give into that fear, you give into this idea of missing out, and then you just jump on it, right? But we have seen, right, and I've been kind of going through the last, like I'm going through the last set of IPOs, and the one of the last few that is actually up is Atlantic. And the only reason why Atlantic is actually up right now is because of the hurricane. So Atlantic Hardware would have actually fallen in that set as well, because if it wasn't for the hurricane, then Atlantic may not be trading above IPO price right now. So we see Woodcats below IPO price, we see Atlantic below IPO price, and I think we see Omni below IPO price. The last three IPOs, I believe. Let me know if I missed any right there. So again, I'm not speaking anything about the companies themselves. It's more about this idea that I'm speaking to persons whose investment strategy is to buy IPOs and nothing else, right? Now, if you told me you made an investment in a company because it fits into your portfolio, it presents a unique opportunity, you like where the company is headed, you like the overall, prospectus, projections, etc., that makes sense to me. That is a good investment decision, all right? So the truth is, there are a few of them, and an increasing number of them that are not performing to expectations, right? So they may list, and then the first quarter, the second quarter is not really performing the way that you are expecting to, or maybe there are these plans that were articulated, and then a year later, maybe the company is not able to execute. And so it kind of creates this. So I've had this rule for a number of years. I mean, persons would have heard me say it a while now. I've been saying it for at least 2 years, that for IPOs, I have a personal strategy that company at least a year to show me what it's capable of. Because when a company is private, about to be listed, I don't have any data. I don't have history. I don't have, I don't know which quarters are better than the next. I don't know what's the seasonality of the business. I don't know how the company is going to adjust to the new listing expenses, or I don't know how well they are with compliance and things like that. So if the business is in an industry that I relatively don't know, I'm kind of at the stance where I want it to prove itself by going through the first year. So typically, even if I buy into an IPO, I am not going to a certain level of position until I've given it a year. And then if I'm convinced, then I would put a sizable amount on it. That's how I've approached the last few IPOs, right? So I'm trying to remember the last one I did this with. So I think the last, oh no, I don't want to divert and get into my personal portfolio, right? I'm making a point here. And there's this kind of thing that I've also noticed where, or at least this again may not be all the time, but sometimes there are times where the positioning or the time that an IPO is presented is at a particular point in a company's growth stage, right? So for example, there's such a thing I've heard of as companies, some companies trying to time when they IPO. So this idea that you want to kind of present the company in a certain way, and that's why sometimes I think it's a good idea to maybe wait and give the company some time to prove itself, go through a quarter, go through two, and then you'll be able to see what the numbers look like, right? So you get a feel for the type of performance that the company is capable of, especially if we don't have a lot of history, right? I also have an issue with that where sometimes you don't have enough history on the company within the prospectus, where we're not seeing a quarter by quarter breakdown. We're not seeing, the last 3 years, 4 years, 5 years at times. Sometimes we're just seeing the full year, and you don't always know if they had a great quarter and 3 average quarters, or they had 2 really good quarters and 2 really bad quarters. What you're seeing is a high level number for the year. And you're not always now aware of the context as to that performance, right? So it could have been a major contract or a major deal or something that was able to put it over the top that led to that growth that may not be taking place in the year that you are considering purchasing that IPO. All right, so hopefully you get where I'm going here. So this idea that your investment strategy is just buying into the IPO is not a sound strategy. All right, so hopefully you get where I'm going so far. So I say Lavaine said, I remember those days I was an IPO investor, then COVID happened. I think that most new investors would fall into that trap. Honestly, I did too, right? When I just started investing in 2017, I think I bought into every single IPO. And then I think after one called Everything Fresh, when I think that was the first IPO that I bought into, that it went up ever so slightly and then went down significantly. But the broker actually had an issue. So the broker at the time sold my shares without my permission. It actually sold it at IPO price. So even though the stock went down lower, I really only lost fees because they made a mistake and sold my shares without telling me. So I was like, I'm not going to complain. You sold it for me when I didn't want it sold, but you sold it for me and you saved me some money, right? So that kind of thing has happened, right? So I think everybody's kind of it has happened to us, right? So there are 2 kind of ways I want to take this video. So one, I want to stop you from kind of thinking that every single IPO that comes out you need to jump on it. And of course, I'm making sure I wanted to do this video for a while, but I've never wanted to do this video while an IPO is out, because I don't want anybody to believe or think that I'm like singling out any IPOs, right? So I made sure that the one that is out now, that has passed, has closed, so you don't hear that Jermaine said anything that might have caused some issues there. But this is something that I've wanted to talk about for a while, but every time I sit down to do this video the IPO would come out, right? So I wanted to save it until a point where there's nothing happening, and then we could just have a conversation about it, because I think it will help brand new investors to do so. All right, so it's this idea that I want new investors especially to think about their portfolio in a certain way. I've always said this, I've been saying it on our channel for a long time, that I believe new investors should have 4 to 6 stocks maximum, right? 4 would be great, 6 not so bad, right? And I'm going to break down the 6 a little bit soon, right? What type you should have and why, get into the type of stocks and things like that shortly. But it's this idea, and I'm going to talk about some of the reasons why you should maybe have that number of stocks, right? So for example, the more stocks you have in your portfolio, the more research you have to do, the more management you have to do, the more tracking that you have to do, the more reports you have to go through, the more news you have to stay on top of, the more sort of headache you have trying to figure out, you know, which one do I sell now, or which one is the one to hold on to it, especially if some of them aren't doing well. So you start to have this kind of, you know, mental fatigue trying to manage your portfolio simply because you have too many stocks. All right. And so it brings me to this idea of, you know, something I've been saying on this channel for a long time, that you concentrate to build wealth and you diversify to maintain your wealth. So it's this idea now that the 4 to 6 stocks to me is a sweet spot where it will allow you to build out a sizable portfolio, build out a solid portfolio. And if you do see an IPO that comes out that you believe is a great opportunity, I think that you should decide which stocks in your portfolio you are going to replace with that IPO. Now, if you can't find a stock to replace, it means that the opportunity or the offer is not compelling enough for you to do that, right? Hopefully that makes sense to you. So it's about this concept of opportunity cost, right? So if you see an IPO, it comes out, you're not convinced, and the only thing that's getting you to buy into that IPO is FOMO, even to the point you'll be like, well, I just put a $10,000 on it or a $20,000 on it. That very idea tells me that it would almost be better, or it doesn't make sense for you to take that investment decision, because if your portfolio is $2 million and you're putting just $10,000 on an IPO, even if that IPO doubles, you're gonna have $20,000, right? That's not gonna move the needle for somebody with a $2 million portfolio. So that just means you're literally acting out of routine or a FOMO. You're not really sold on that company. You just don't want to be wrong. You don't want to miss out anything. And again, that would be you acting out of fear. All right. So I've also said to persons that if you think about and notice, those of us who we consider wealthy, right? The Elon Musk, the Bill Gates, the Michael Leachins, their wealth is usually concentrated in one company, essentially one stock, right? So Michael Leachin is famous for owning a significant portion of NCB. His wealth is concentrated into one stock. Now, he may have other stocks in his portfolio, I don't know, but his wealth is concentrated into NCB. So NCB is where, you know, he would have made that purchase. He has a certain number of shares. He doubled down on that stock, and that's where his wealth was able to grow, right? As that price continued to go up, he was able to build wealth. But he didn't have 40 stocks, 50 stocks trying to build a similar way to build that out into building wealth, right? Same for Bill Gates, same for Elon Musk, etc., etc. So it's this idea that usually the persons who I coach, for example, who are wealthy, who have, you know, a certain amount of wealth in their portfolios, and I'm talking significant amounts. I can't, of course, share that information here, but there's a commonality. All right. So there's this thing now that I'll talk about as to how you should kind of look at your investment strategy. So Warren Buffett speaks about this thing called a circle of competence. And I think that should inform how you invest, right? So your circle of competence is essentially that area, that circle that you can develop real skill in, that you're already good at. And so you invest according to that area of competence or to your skill set. So for example, when I'm coaching persons, I'll ask them, what kind of work do you do? What industry are you good at? If you're a doctor, then I'll say to you, look at medical stocks, because you may understand those a little bit easier. If you're in retail, you may understand stocks like Fontana. If you're in logistics, then you may understand like Kingston Wharves. So it's this idea that you stay within your circle of competence, because that's when you will naturally shine, right? So you want to build a portfolio with stocks surrounding your circle of competence, And that will also lead to a certain amount of conviction in your portfolio, right? So you won't have these, 30, 40, 50 stocks. I think a year ago, we were doing a video and somebody said they had like 43 stocks, right? I don't remember his name right now. I think his name was Omar, I don't remember, right? 43 or 45 stocks or something like that, right? So I would have loved, no, I didn't ask that person, but I'm imagining that is probably the IPO strategy that got him there. He probably bought into just every single thing that came out, or bought every single stock pick, or bought every single thing that was mentioned to him. So no, I don't know what happened to that person, but I can just imagine how hard it is to manage that portfolio. All right. So you want to focus on your circle of competence. You want to focus on building a certain amount of conviction, and you want to just have the patience to continue to build out that position and to accumulate your wealth. All right, so I'm going to pause there. I'm going to see if there are any questions. Yes, 43 stocks is what they had, or more. I don't remember the exact amount. All right, so so somebody said that West Indies Petroleum is above IPO price. So I'm happy that you said that, right? I specifically didn't count that one because that wasn't an IPO. That was a listing by introduction. Now you may say it's their first time listing, so technically it's an initial public offer. But what they did is it's not your typical IPO. In this case, the company was not raising money. They simply just listed the shares, and based on how that business is structured, that is what led to the run up in price, right? So that was a very strategic way to list. Now we have other stocks who listed by introduction and didn't do as well. So certainly that specific one should be studied. But when you have such high concentration of shares, because if you look at the shareholding for West Indies Petroleum at listing, I think like 90% of the shares were with maybe the top 2 or 3 shareholders, or more than that, or 95% or something like that. And then there was like an employee pool, and then that was it, right? So there wasn't a lot of liquidity to those shares, and that's what drove up the price, because there wasn't enough supply to meet the demand, and so the share price is going to go up. All right. So so Kerrick said, I've been waiting for this. I have so many questions. So go ahead and ask your questions, Kerrick. Ask your questions. That's why I'm here, right? So I want to take as many questions as I can. I'm here to help you. If you're a brand new investor, especially, that's why this channel is here. We want to help you to get better at investing. All right. So good night to you as well. Hopefully you and your family are doing well. All right. Buying West Indies Petroleum at this price is crazy stuff. I mean, it depends, right? It depends. There are some who think that it's underpriced. There are some who think there's more to come. I'm not a shareholder currently, so I can't speak to you right now. Any advice for an 18-year-old actively trading on the stock market? Is that the Jamaican market or the US market? Let me know. And what advice are you looking for? I mean, that's a very broad ask, right? I can't just give random advice, right? What are you struggling with? Are you making money? How many stocks are in your portfolio? You can tell me that, and I can say how best I can help you. But I mean, the fact that you're investing at 18 years old, you started 15 years before me. So maybe you should be teaching me something. I don't know. I don't know. Right. Okay. Risk management. So I would say with risk in particular, it's interesting because I think as an 18-year-old, I wouldn't necessarily be worrying about risk management, especially if you don't have a lot of capital. I'd be more worried about you learning what drives the market, try to understand businesses, trying to understand the market, trying to understand investors. You'll make some mistakes, you lose some money, but that's a part of the process. So I wouldn't necessarily worry about risk management until you start accumulating serious capital. I would say, you know, master the basics is what I'll say. You know, try to get as much money made as you can. In terms of at that age, I'm thinking that your income may be limited, I may be wrong, but you want to make as much money as you can, you want to invest as much money as you can, and you want to learn how the market works. So for example, our level 1 course would help you, or our level 2 course would help you. And you know, we have persons in our level 2 program now who are 21, 22, 25, and they're doing really well. So I would say focus on learning, not so much managing risk at this point, because you don't know what you don't know, and it's too early to try to implement any one strategy, especially if you haven't really developed your investment style. So I would say try to figure out what that is first, and then your risk management strategy should fit into your style of investing. All right, hopefully that helps. Somebody's asking, where's the dividend portfolio video? I didn't get to do that video. So it is in my back pocket, and at the right time, I'll do the video. All right. So it's deleted only because I don't want to keep changing the date. Right. But the video is planned, and I'll go through it when I can. All right. Yeah, level 1 is free, but after you finish level 1, you move to level 2. Right. So there are 4 levels. Try to get through all of them. All right. I've had 13 stocks a few years ago. Presently, I have 2 on the local market, 1 on the US market, and they're doing well. Well, there you go. So 3 stocks is pretty good. Do I think NCB will ever go back to previous highs? That depends on them. That depends on the future. That depends on the state of the business, the state of the economy. That depends on quite a few variables. Now, do I think it has some growth from where it is now? Personally, I don't know. I know a lot of people who are very bullish on the company, but I haven't been following it as closely as from when they did the last IPO, right? Because I was very optimistic on where things were headed after the last IPO, but that was before I started to really understand just what was happening, like beneath the surface, like you know, the selling of shares, the debt that is, you know, still accumulating, that is coming due, and things like that. So for me, I'm sort of trying to watch to see how they're going to continue to grow, because the growth, I think, is the part that I'm struggling to see. Now they're certainly stable, but what I keep noticing are these kind of selling off of assets or subsidiaries, and I'm trying to figure out where other growth will come from. Because if you sell something, you may realize a certain gain, or you may get some cash, or you may be able to realize, you know, something in the short term, but where does that leave the company long term? So I'm just kind of watching to see. I'm honestly not sure, right? The last person I spoke to who worked at NCB, who was very bullish on NCB, that was before it went to $53. He was like, you know, it was at $40 at the time, and he's like, you know, there's more to come. And I'm like, let's see. So I don't know. I honestly can't tell you. I haven't really looked at the company in a while. So, you know, I wish them well, though. I must say that I'm a fan of NCB, the company, the bank. That's where our business account is. So this is just a stock conversation here. Do I think 20 stocks is too much? Absolutely. Absolutely. If interest rates climb due to inflation, they have some issues. There you go. People must. Oh my gosh. Thank God I followed your investing advice. You know, be careful with the word advice. You know, FSC may be watching. Overall, they're making a nice turnaround. Yeah, that's good. There is no what's next. Why did you say that? Why do you say there's no what's next? Okay, Kerrick, let me see if you ask your questions. Okay, Kerrick is saying, I have 6 stocks all for income. I got excited seeing the coaching. Then the requirements came out. And I'm like, I'm not there yet. Kerrick, that's okay, right? So for those who to know what Kerrick is speaking about, and Kerrick is over on Instagram, we did a call for coaching over the last week, and that program literally, became full in about 5 days, right? So, we had only 10 spaces, about 30, almost 40 persons reached out. So after the first email, I realized that I had to send out the requirements because I had to kind of be explaining the same thing over and over again. And then so I put the requirements, and so some persons saw the requirements, said they were still interested. Then we had a conversation and they didn't meet the requirements, right? The reason why we have the requirements for coaching is that we have other ways to help you if your portfolio is at a certain level. So it's not discrimination. It's more about the best value for time on both sides, right? Because sure, I can teach somebody who's brand new investing. I can coach you, I can teach you. But if you're making your first purchase, that may not be the best way to utilize coaching, because coaching is going to be more expensive than level 2, right? Level 2 is $8,000 a month. And if you want to, as a brand new investor, learn how to invest, then level 2 is what you should focus on. So what I did was, for those who didn't meet the requirements for coaching, I just, recommended that they focus on level 2, and that's what most of them did. So either way, though, we're able to fully subscribe the program, and that coaching starts, June 1st, right? So we're not going to have a call again for coaching until June 2027 or January 2028. And that's simply because I can only coach so many clients at a time. And that's because, we have a certain number of clients already. So we have to kind of wind down a few first, see if anybody, decides to leave the program. And then as persons leave, that's when we welcome new persons. But if nobody leaves the program, then we can't do another call for coaching. So that's how that works. All right. How do I pick better growth stocks? Great question. All right. So I'm going to answer that question in a minute. All right. What's your maximum threshold for the amount of stocks to invest in? 10? Yes. That's actually my maximum. At one point in the most recent times, we had 10 stocks. Now we're down to 4. We have 4 stocks in our portfolio now. At the end of the year, I may do a review. I'm not sure yet. I'm being very careful about the stocks that I share in my portfolio now. I used to do that in the past, but then that, yeah, I'll leave that alone for now. So we're not going to share my personal portfolio anymore, so there's that. So the government has 6 billion USD to spend. Which companies are set to benefit? Follow the money. All right, cool. I got you. So tell us which companies stand to benefit. All right, so let me get to the 6 stocks that you should own. Right. So I'm going to explain that now, and then get into it, and then we can kind of talk about how to manage it from there. Then we take any questions and wrap up the video. All right. So to recap what I've said before, for those who are just joining, I want you to stay away from this strategy of buying every single IPO, right? IPOs, they create excitement, they get a lot of media attention, but they also create a lot of FOMO, and then create this idea of, investors maybe going against your strategy or going against what they originally planned. Because as I said, an IPO is like an interruption, right? You're going about your business, and then bam, prospectus comes out. You're now in this frenzy about trying to make a decision about something that you may not be ready to make in that short time, right? So again, this is not a knock on any specific IPO. This is just a strategy that I see that some investors have, where every single IPO that comes out, they're just buying and buying and buying. And then afterwards, they end up with 20 stocks, 30 stocks, and they're not really taking a very careful approach to building their portfolio. Right. With that said, I recommend that beginners, brand new investors, focus on 4 to 6 stocks. I'm going to explain what those 6 stocks should be, and I'm going to start that now. Right. So I'm going to break it down in three types of stocks. Now, there are other types. We're going to start with three, right? So the first type of stock is a value stock. You've heard about these stocks, before. These are your blue chip companies. These are your undervalued stocks. These are the stocks that they'll say, this is trading at a low PE, so it's a buy, it's a recommendation, right? So value stocks are this idea that you're purchasing stocks that are undervalued, and your hope is that the market will see the value in these stocks at a later date, right? That's probably the most popular type of stock, meaning that's likely the type of stock that's going to be recommended by your broker, right? Pros and cons of it, I won't get into that in this video, but value stock is one of them. So you can have, as a new investor, 2 value stocks in your portfolio, all right? The next type of stock is an income stock or dividend stock. Now, a dividend stock is a stock you purchase specifically for the purposes of receiving income. Now, the stock can provide you with capital appreciation, but that's not the primary focus of you owning that stock, meaning you're going to hold the stock. So even if it appreciates in value, you're not looking to sell it because you're looking for cash flow. You're looking for consistent income without having to give up, potential future dividends, right? So investing in income stocks are simple. You calculate your dividend yield, and to calculate that, you look at the annual dividends paid divided by the share price. You get the dividend yield. I recommend dividend yields of 5% or higher. If it's lower than 5%, especially if it's lower than 2%, it is not a dividend stock. All right? I said what I said. So as somebody who is starting out, you can have 2 income stocks in your portfolio, right? Of course, you have popular ones in terms of income stocks, like, Trans Jamaica. You may have Sterling Investments. You may have Cygnus. Those are, well-known kind of dividend stocks. They pay consistent dividend, and I think the yield, I don't remember the yield for Cygnus right now, but Sterling is good, Trans Jamaica is good. And the final stock that you should have are growth stocks. Now, growth stocks are typically smaller companies, the junior market companies, that the expectation is that these companies are going to grow and grow rapidly. Now, this is where I think it relates to the whole IPO frenzy thing, is that usually the IPOs come out for growth stocks, for growth companies, for junior market companies. Now, whether or not this is the right growth stock for you is what you should personally assess. Each person should assess that for themselves. But a growth stock is the expectation that this company is going to grow and grow at a fast pace, and then investors are going to respond, the price is going to go up. That is the expectation, right? Now, if you have this stock in your portfolio, you're not necessarily expecting it to pay any dividend because it's likely a smaller company. It's in its growth phase. It would have gotten the junior market tax break, so they're not paying any income tax for the first 5 years. They're positioned to grow. Not every growth stock is going to grow, right? It could be performing out of character, and that's when, of course, the price will suffer, right? So when you purchase an IPO that's a growth stock, and the first report, the second report, the third report is bad, and the price continues to trend down, you have a growth stock that's not fulfilling its purpose, right? If you want to say it in that term, right? So we have a growth stock that is out of character, right? I can think of a stock that came out in the last few years that's down as much as like 60%, 70%, 80%, right? So it's a growth stock that has not, figured out the formula to grow, right? There are some stocks now that are like 25 cents, and they came out at $1. That's 75% down, right? So if you have that stock in your portfolio as a growth stock, you have to understand that growth stocks are volatile. Growth stocks can swing in price very quickly. They can go up quickly, but they can also go down quickly. All right. So you can have 2 value stocks, 2 income stocks, 2 growth stocks. The value stocks are likely to grow and move steadily. The income stocks are likely to have short bursts in stock price growth right around the time of dividends. And then the growth stocks will go based on how their performance or any announcements or any news around the company goes. So the 3 stocks perform differently, but when you have 6 of them, you can focus your attention. You can try to manage each stock based on what it's for, and you can go ahead and build out that portfolio as you grow as an investor, right? So that's the meat of the video. Hopefully that makes sense for you. Let me know if you have any questions here and I can answer them, right? All right. Did I answer your question? How do I pick better growth stocks? Okay, Carrick. So to pick better growth stocks, you want to start by understanding the business really well. You want to look at how the company is positioned, right? Because the growth that we're measuring is growth in net profit. So how I categorize a growth stock, or the growth stock I look for, is a company that can grow at minimum 20% in net profit, right? Whether quarter over quarter, whether year over year. So if a company does 50 million in profit last, and I purchase it as a growth stock, and the next report is not 60%, is not 60 million in profit, or the end of that year is not like at least that 20% or 30% growth, to me, it's not a growth stock. The market is not likely to respond very well, because when the performance is flat, there's nothing to be excited about, right? Because the market is going to respond to things that are going to lead to a more profitable future for the company, regardless of how you slice it, whether it's an acquisition, increased performance, turnaround revenues that are going to lead to more profit, like most of the things that investors get excited about will usually lead to spelling more profits for the companies. So you want to just find those industries that are primed for growth. Look at Atlantic as an example, where investors became bullish after the hurricane, not before. You notice it was down before the hurricane. Hurricane came, then everybody anticipated that they would grow as they are a part of the rebuilding for Jamaica. And you did see growth. The first report we saw after the hurricane was good. The second report that we saw after the hurricane was good. So that is a growth stock that has a driver for growth, has a trigger for growth. So that, hope that helps you, Carrick. That's as much as I can say in a YouTube context, right? Hopefully that helps you. All right. Exactly, Junior Politics. He says only a few junior market companies is doing that, like L.E.A.R.N Fesco, and that's why you don't need to have 20 or 30 of them in your portfolio, because there are only a handful of companies truly growing. Fesco did, 749 million in profits, 65% growth in net profit. That's the kind of company you're looking for. Dollar Financial, I think, had a great year despite their challenges, and so on. So you want to look for, I think RPL also did 108 million in terms of growth. They did 86 million the previous year, then they did 108 million. That's 22 million growth. That's about 25, almost 30% growth. That's the type of growth that you're looking for. All right. What's happening? Jevigi, you can't watch this right now. What happened? All right. Great question, and I'll answer that shortly. Right. So the question is, isn't sustainable growth important for a growth stock? It depends. Now, it depends on the person's time horizon, right? So you could actually have a growth. So remember, investors can be investing for short term, medium term, long term. So if you're investing for short term, the growth doesn't necessarily need to be sustainable. Once there's growth, somebody can just simply trade off that growth, or that anticipated growth, or that perceived growth. And then a person may move on, and that's it for them. They would have met their objective for that growth stock, and they're good. But now if somebody is wanting to build out a portfolio, and this is the context that I'm talking about for this video, not necessarily short-term investing, but building a portfolio, then sustained growth is important. So for example, I'll call out a stock like RPL here, where RPL has shown consistent and sustained growth, right? They've grown through acquisition, they've grown through just growing their business, they've grown through, having more gas stations. So they have shown, sustained growth over 2, 3, 4 years. They've been listed just 4 years now, right? So RPL is a perfect example of sustained growth, and we've seen the stock price grow as well in tandem with that, right? So Jevy G is asking, is there a way I can watch this after the live? Yes, the video will be up. It will remain. It's not going to be taken down. So yeah, watch it whenever you're ready. Save the link. Watch it whenever you want to, right? Well, once it's on YouTube, it will remain on YouTube, and so you don't have to worry. All right. So which 2 growth stocks would you recommend for someone who just started investing? Officially, things I can't answer that question. So when it depends on, let me help you to try to identify a growth stock. Let me see if that's a better way to approach this question, because I can't tell you through two growth stocks. Now I can point you in the direction of growth stocks, but it's for you to decide which stocks you want in your portfolio, right? So remember that what I said earlier. Focus on your circle of competence. Focus on industries that you understand. I'm not saying you buy the stocks only in the industries you understand, but you can start your research there. What I tend to do for growth stocks is I focus on what's going on in the economy first, which companies I think will do well in this economy. Then I look down as to know, okay, which companies are in that sector. A perfect example is a few years ago when the government decided to increase the duty-free limit from $50, I think, to $100. When I saw that, I took a short-term position in Mailpack because I anticipated that, because the limit is now increased, the entire shipping industry is bound to do better because persons will be more inclined to purchase more online. And we're seeing companies like Rocket Ship, like whenever I go to Rocket Ship, it's like packed. So at the point that announcement was made, I think the stock was maybe trading at like, it was either then or shortly after. I was able to purchase maybe for about $2 or 2.8 or something like that. And I was able to sell later on that year at about 260 or 270, right? So I looked at what was happening in the economy. I looked at the industries that would have been impacted. I looked at what investors are likely to turn to in terms of, looking for growth. And I think it took maybe 2 or 3 quarters and I was able to get, I think, 30% growth out of that position. It was just a short-term move for me. And so I was able to identify that opportunity and I was able to do that, right? So I don't know your skill set. I don't know the areas that you're interested in. If you were in level 2, I'd be able to guide you a little bit better because we could have a conversation about it, right? But I would say you need to first learn how to identify growth stocks. You need to understand what are the drivers of the growth for that stock, right? So is it going to grow normally? Is there demand for their products or services? Are they likely to grow? Again, my benchmark is at least 20%. Yours may be different. And really you're asking yourself the question, are investors going to be willing to pay more for this company 3 months from now, 6 months from now, a year from now than you are paying for it now? Because for you to have a growth stock, if you pay $1 for it, somebody has to be willing to purchase that from you for $1.50 and think that they got a deal, right? That's how growth stocks work, right? Where the person who is selling is thinking that there's no upside. The person who's buying is thinking that there's upside, right? So hopefully that helps you officially. Hey Tajay, I hope you're well. Is the same rule for selling growth stocks at the same 20%? No, I mean, selling is a personal decision. So Kerrick, you sell whenever you get to a profit target you're comfortable with. That's up to you. It's not for me to prescribe when somebody sells. That's up to you. We've seen companies like Lumber and Image Plus doing that. Lumber have a major stake in Atlantic. Yeah, for sure. Hi, Jermaine. When researching a company that's already listed, what should be the main areas of focus? Ingrid, you're in level 2. I will answer that question for you in detail. Join us for the check-in call next week. We're having a check-in call next week, Saturday. I'll answer that for you. Just remind me, right? Just send me a DM, or when we start the session, just ask me, and I'll give you a detailed response for it. All right. But we covered that topic already in March, but of course I'll give you an answer, of course, as you have asked. All right. Another question is, what stocks to watch if Jamaica strike gold with oil in the distribution space? Well, I mean, I think everybody's kind of anticipating that's what's going to happen with West Indies Petroleum. I've seen talks about if Jamaica does strike oil, then West Indies Petroleum price should go up, because the expectation is, since they do things like storage, there's going to be more demand for their services. Which other companies that I can think of? I think that's the only one. So I think, West Indies Petroleum is what the market is expecting is going to do well, should there be, something like that. I don't know how to speak to that, really. I haven't really thought about it. I think I'm mixed about it, right? Do I want us to strike gold? Because I've heard that, persons saying that Guyana isn't necessarily better off now. I take that with a grain of salt, right? The country's wealth has significantly increased, but there's this idea that if there's oil, then countries like the US may want to come and kind of monopolize it, or take control, or start a war with Jamaica or something, right? Just to get that resource. So I think there's a part of me that's like, I don't know if we want that attention. No, I haven't thought about it in full. I admit that I'm kind of limited in knowledge and perspective in this area. So I'm saying that to say that I'm not the best person to ask for it. Maybe my wife would be able to answer, because she worked in the petroleum industry. I'm not sure. Jamaica politics is saying it will take 3 to 4 years for West Indies Petroleum to benefit from oil discovery. Now, it may take them 3 to 4 years, Jamaica politics, but the market may not treat it that way. You understand? So there are things that the market may respond to in the short. So the market will respond to news positively when the realities for the company may not be in the short term. Hopefully you understand what I'm saying. All right. Do you think every stock's price will eventually increase by virtue of just the asset price inflation and new entrants into the market just at a slower rate? Absolutely not. That's a great question. I hope everybody understands the question that you're asking. That's what you are told. You are told, just buy and wait, have patience, it will all go up. That's not true, right? I think there's more to it than that. I think the buy and hold strategy does not work in our market. I think our market is too nuanced for it. Now, people will be people, right? So there are certainly certain behaviors and patterns that are common and consistent across multiple markets. Jamaica is not necessarily unique in that way, but our market there's still, at this point anyway, a very small number of participants in our market. All right, when I say small, I mean small, right? So with that, I don't think enough stocks get enough attention. And by virtue of that, Damian, you may have where if the market starts to move on from a stock, as in those investors who are being active, because just imagine if there's no interest in a stock, there's no volatility in a stock, that stock price is not likely to go up, but it will instead start to trickle down and down and down and down. Now you can't say, well, now, if you're asking like if it's a bull market, do I think just everything will go up? If you remember back in 2017, 2018, 2019, back then most stocks were going up, maybe 40 to 50% of the market were going up, but still every stock didn't go up then. So that's why I wouldn't say, every stock. Now, if it's a bull market, you may see more stocks that are maybe average perform better and things like that, but it's not a guarantee. So I wouldn't just buy some stocks and say, let me hold this 10 years, 20 years. I made the point in a video back a couple of months ago that I heard, I think it was the Japan Stock Exchange went down. It started to have a bear market, I think 20 plus years ago, and it's still in a bear market. So there are persons who started investing 20 years ago who heard the market will soon recover, it's going to get better, and it has not recovered since. I think it's a Japan market. I don't know if I have it right, but it's one of those markets that I heard the person, they started to have a bear market like 2003, 2004, and they have not yet recovered 20 years later. So, I mean, it may not, the stocks that you're buying now, Damien, may not recover for your lifetime. It may not recover by the time you need it for retirement. It may not recover, you know, by the time you need to hand that, you know, portfolio over to your children. So I wouldn't just, you know, bank on, I just have some stocks and I can just wait, right? Levine says, also bear in mind that some stocks are cheap for some reason. Food for thought. That's true as well, right? All right, hopefully this was helpful, guys. So just to recap, please, if your strategy for buying stocks is just IPO, hype, you hear Trans-Jamaica going up, so you jump on the bandwagon, you see the price going back down, you sell it. You hear RPL going up, you jump on the bandwagon, then you sell as soon as it goes. Like if that's your strategy of investing, you want to move away from that, focus on understanding more about the market, understand how IPOs get a certain attention, certain marketing. You want to take the time, do due diligence, understand the market. It may be okay to just wait a few months, see how the company develops, see how they're able to, you know, grow the business. And then when you see a pathway for sustained growth, then you make that investment. Now, if that is clear from IPO, certainly go ahead. But just understand, and I was saying this to a coaching client, that they should remember that IPOs are marketed. So ask them the question, have they ever heard anything bad about an IPO? And they pause and they're like, you know what, you're right. I've never heard anything bad about an IPO. Now that is typically because a prospectus is a curated document. It's positioned by the company. It's not often that we get a fully fair and objective like equity analysis. Now, back in the day, we used to get that a lot, but I'm actually calling out companies now. Brokers, if you're watching this, I would love to see a standard or a case where an IPO comes out. We have at least 5, 6, or 7 fair and objective broker analysis, because I think the brokers have missed the opportunity to inform the public fairly about the offer that's out. Now, typically you may see one IPO analysis, maybe 2 at the most, and it's typically by the agents or the lead broker. So to me, it's going to be a little bit, I'm not necessarily saying it's going to be fully biased, but there may be some amount of bias there, because clearly if you're bringing the company to market, then you're going to feel like the company has a certain value or advantage, and it's going to show in your reports. That's fair, right? I would love to see 5, 6, 7 companies put out their analysis so that the market has a more informed and fair kind of mindset going into that offer. I remember when there was the IPO for JFP and the whole do not participate kind of rubbed some people the wrong way. From then I kind of saw brokers kind of step back from doing the equity analysis, because nobody wanted to say do not participate, and then it becomes this thing where they're kind of like feelings being carried in the market and that type of thing. That doesn't benefit investors, because investors now miss out on the chance to get fair and objective analysis for them to be able to make an investment decision. At the very least, I think brokers have an obligation to inform their clients as to whether or not they should participate in an IPO or not. And I have 8 brokerage accounts. For the last few IPOs, I have seen probably 1 or 2 IPO analysis at the most. It's usually persons like us, like Kalila, like, you know, other persons in the space. You know, we're the ones doing reviews of the prospectus, and we're not licensed financial advisors. We're not brokers. It shouldn't be coming from us, because our role is to educate our role is not to advise. The brokers have the opportunity to advise the market as to what they think that offer should be, right? Sorry for that mini rant. Hopefully you get where I'm coming from. Adrian asked, do you have any videos on JTrader explaining how to understand the queue? I believe I do. There's a video on JTrader. Check that out. Look on the videos. You should see one there. Just sort by view count. It should have like 10,000 views or so. I bought into IPO Woodcats. That was your first IPO. Okay, cool. I agree. I asked one broker for their review on the recent IPO in February, and they said they weren't interested in doing one. The lead brokers would. Yeah, so if the lead broker, just imagine this, right? The lead broker is doing the IPO review. If I did not, it just doesn't make, like, to me, it's almost like a conflict of interest type of thing, because the company coming to market is the client of the broker. It's a client, right? So the company is paying the broker to do the IPO. Do you think a broker is going to be so the broker may put the risks in the review, but they're not going to be sharing it in the same way as if it was somebody else's IPO or somebody else's offer, right? So yeah, it's like you can't ask the seller of the produce for a review of said produce. Yeah, I mean, so it's just kind of, I always say to persons, like, you have to take the broker analysis with a grain of salt depending on the company, because there's also a certain type of affiliation between broker and certain companies, where you'll never hear certain brokers speak a certain way about the companies that maybe they brought to market, or maybe they have an ongoing relationship with, and things like that, right? So, you know, there's that. So it's kind of always been weird to me that we don't have a more like objective market where, you know, we don't see, you know, consistent and fair analysis. We don't see consistent, you know, reviews. Like, the standards aren't really held high in terms of the market and things like that. It's disappointing for me, you know, because I'm here trying to get more people to invest. And it's like, you know, the brokers will only pay attention if it is that they're the ones bringing the company to market, right? So I can't tell. I mean, back in 2017, 2018, would say so many broker analysis, equity reviews, and stuff like that. Because when I do a Google search for those now, it's all, you know, 4 or 5 years ago that I'm seeing. They're not done as often anymore. Well, that's because some of the brokers have laid off staff as well. So there's that. People are scared or don't want to be objective. That's true, right? That's what I've seen, of course, as well. It was okay for 2 days after listing. I will leave that one alone. All right. Thanks, guys, for watching this video. Hopefully it was valuable to you. If you found it valuable, please give the video a like. If you're brand new to investing, check out our free level 1 course. The link is in the description of this video. If you're already investing but you're not making any money, you don't understand when to buy stocks, when to sell, you want to understand investing better, level 2 is the program for you. Join our level 2 class. We have it the 3rd Saturday of every month. If you sign up now, you get 1 month free for the rest of the year. Just reach out to me and I'll send you that special code. The code was sent out in an email and posted in our community, but if you're brand new, I'll send it to you. So we have 6 more months to go for the level 2 cohort for this year. So if you want to learn investing, you want to know how to make money and to understand it, the level 2 class is for you. Those are the 2 levels to start with, and then you can always, you know, aim for level 3 and level 4 as you get better as an investor, right? So have a great weekend, guys, and I will see you again real soon.
Does this sound like you? You bought into that IPO they told you was a good investment, and now you're down 20, 30, maybe even 40%. You try to buy the stocks they talk about in groups or on social media.
You've even taken a chance on the ones your advisor sends you via email.
But after 2 years, that IPO, that stock is still down.
There's a clear difference between investing and making a good investment decision. So if you're stuck, What you need to do is learn how to invest the right way.
In our L.E.A.R.N Level 2 program, we teach you how to build a $1 million investment portfolio. To make money investing, you need to know which stocks are right for your investment strategy, know when is the right time to buy and sell, and know how to build the right portfolio for your investment style. This program will help you invest meaningfully while making money. When you sign up, you'll get monthly guidance on how to invest and make money while doing it. You'll have a community of investors on the same journey as you to support you, and you'll have resources to help you stay on track. Join our 2026 cohort so you can get back on track with your financial goals.